Recently, I trimmed some of my positions in Alibaba and UNH, where I was up 135% and 35% respectively. With part of those gains, I decided to reinvest in a small cap company that I believe is undervalued and has the potential to deliver over 20% annual returns. The company is Nomad Foods. Nomad Foods has a market cap of about 1.9 billion, yet generated 3.6 billion in revenue over the past 12 months. This is a wonderfully boring business. They sell frozen food, frozen fish, vegetables, and prepared meals, primarily in Europe. It's a simple business to understand, and they're the market leader in European frozen foods. Now, it's not a huge market like cloud computing or e-commerce, but it's a stable and defensive one. Over the past decade, Nomad has grown its revenue steadily from 800 million to 3.1 billion today. Analysts don't expect much growth ahead, projecting revenues of about 3.2 billion in 5 years. Personally, I think that's too conservative. I expect them to grow at around 3% annually with inflation. On the profitability side, their net income is 211 million, but what really stands out is their free cash flow of 366 million. That means the company is generating significantly more cash than its net earnings suggest. Margins are also healthy, with a 7% profit margin and an impressive 12% free cash flow margin. Looking at earnings per share, analysts project $2.23 per share in 5 years, which implies a forward PE of just 4.8. That's extremely cheap for a company with this level of stability and cash generation. And here's one of my favorite aspects: share buybacks. 5 years ago, Nomad had 197 million shares outstanding. Today, that number is down to 157 million. That's a huge reduction, which means shareholders now own a bigger piece of the company and its profits are spread across fewer shares. Despite Nomad steadily improving its fundamentals, the stock has sold off heavily. Over the past year, it's down about 31%. In the past month, another 16%, and over the last 5 years, it has lost nearly 50% of its value. Today, the stock is trading at levels that I believe are simply too cheap to ignore. It now sits at a forward PE of just 6 and a price to free cash flow of only 4.5. And in order to take a deeper look at the valuation, I use my spreadsheet. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And as you can see, according to my low assumptions, the stock is worth $12 per share, according to the middle, $20, and according to the high, $31 per share. And because the stock is trading at around $13 per share, this means that if my low assumptions occur, you will get a 9% annual return on your money, middle 20%, and high 30%, which are insane returns. And I believe my assumptions are reasonable, as I have the company growing revenue between 0 and 4% over the next 7 years, averaging a profit margin and free cash flow margin between 7 and 11%, and I assigned the PM price to free cash flow at the end of the 7 years of 7, 9, and 11. I also assume they buy back 2% of their shares annually. Moreover, they currently pay a 5.2% dividend yield, which has a payout ratio of 42%. This is what percentage of their net income is used to pay the dividend, and therefore it is a safe dividend. On top of that, insider ownership is fairly high. The two co-founders still own about 8% and 7% of the company respectively, and the current CEO holds roughly 3%. Those are significant positions, which means management and founders are strongly aligned with us, the common shareholders. The main concern with this company is the debt. Nomad carries over 2 billion in long-term debt, which is roughly 5 times their annual free cash flow of about 400 million. That's a significant leverage level, and it has been the case for quite some time. This is essentially how the company has chosen to operate. To their credit, management has used this debt strategically to acquire brands and grow the top line, but it's still higher than I'd like. Most of it matures in 2028 and 2029. For example, they have an 800 million euro bond due in 2028 with a very low 2.5% interest rate. The challenge is that this debt will have to be refinanced, almost certainly at a higher rate, which could increase interest expenses unless the company prioritizes paying it down. Currently, their blended interest rate is around 6%, which is relatively low for corporate debt and explains why management hasn't focused aggressively on reducing it. Still, I'd like to see more discussion from management about the balance sheet. Another point to note is that a large portion of Nomad's asset consists of goodwill and intangibles, stemming from acquisitions and various brands. That's not unusual for a consumer packaged goods company, but it does mean the balance sheet isn't exactly clean. Overall, Nomad carries a meaningful net debt position that investors should monitor closely. So this is quite a risk in investing in this company, but I believe the company is just too cheap to ignore. I hope you found this video valuable. Let me know what you think about this company in the comments, and I'll see you in the next one.